Good afternoon, Byron Eagles. Today I would like to talk to you about Americans and credit. Um, as far as consumer credit, relatively new concept. Um, it has been within probably the past 60, 50 years that the use of credit actually to buy things like clothing, food, transportation, furnishing um, actually came to the forefront. Before I do anything, though, I have to define credit. Credit is simply defined as using tomorrow's money today. Credit is an arrangement in which you would receive either cash or a good, a product or a service now, and then pay in the future. Now, it's important to understand that the original amount that you borrow on your credit or on your loan would be your principal balance. So if I were to charge $5,000 or borrow a loan for $5,000, that would be my principal balance. That's my original amount borrowed. Usually, typically what happens is the credit card company and or bank is going to charge you interest on that loan. Interest is the amount paid to use their money in the short term, and then eventually pay that back. So interest is the amount paid to someone else to use their money. Quick, did you know over $1 trillion a year are spent using credit cards? And the typical cardholder carries anywhere in America from 8 to 10 credit cards, with an average monthly balance per month paying a balance of roughly $3,900 or $4,000, which equates to about 98% of your total disposable income. And if remember, disposable income is the money you have after taxes are paid to pay for your necessities, your bills, your food, clothing, shelter. So 98% of your total disposable income is going to debt or credit card debt. Finance charge, be careful when you do apply for a credit card. There will be other additional charges. Finance charges includes things like the interest rates and any additional fees, which I'll talk further about in a minute, such as service charges. It's important that you know the APR, or the annual percentage rate, on your credit card or your loan. APRs are the percentage of cost of credit on a yearly basis. The APR, the annual percentage rate, is the only true rate, or provides the true rate of interest for comparison with other sources of credit. So make sure you are familiar with the APR, the annual percentage rate. Now, choosing and using a credit card. College students, young men and women, are a target for credit card companies, credit card solicitations. If you plan to get a credit card and you are going to use it, look for a credit card that has no annual fee. So read the fine print on the back of the application. Look to make sure that it has no annual fee, which means they are not going to charge you a fee each and every year just to carry that piece of plastic in your wallet. Look for a low interest rate. If you plan to carry a balance, if you are going to use it periodically from time to time, make sure it has a low interest rate. And again, interest is the amount that you have to pay back in order to use someone else's money, in this case, the credit card's company's money. The interest you pay on that consumer credit, remember, is not tax deductible. So when you file for your taxes, again, you can't use it as a write-off. It is not tax deductible. And avoid it from falling into the minimum monthly payment trap, which is if you borrow $1,000 on a credit card or use $1,000, you don't have to pay that entire $1,000, that principal balance. You don't have to pay it off in full. What they will do is let you pay a monthly payment, minimum monthly payment, which is typically you're just paying the interest. You're not paying toward the balance of the credit card. So avoid falling in the minimum monthly payment trap. Also remember, you can purchase credit insurance, which would be basically the credit card company would be paid off if that person who currently is on the credit card becomes disabled or were to die. So they do offer credit insurance on most credit cards. Credit card tip, again, when shopping, shop wisely for a credit card. There will be chances in which you could make a huge difference if you were to, let's say, change your interest rates from one card to another. For example, let's say you have $57 in your first year. When you save, you switch the $1,000 balance from a 19.8% interest rate to a 14% interest rate card. So let's say you have a card that has a 19.8% interest and you switch to a card that has a 14% interest. If you had a $1,000 balance on that credit card, it's going to save you some $57 just in the first year by simply switching to a lower interest rate or a lower interest rate on a card. Also, if you are a card carrier, you can ask the issuer for a lower interest rate. Or if you're on economic times, hard economic times, you fall, unemployment, whatever happens, you're a student, you can ask them to waive any annual fees that may be attached to that card. And again, an annual fee is simply a fee you have to pay every year annually just to be a card carrier. According to our textbook, there are 7 factors that determine the cost of open credit. First, what is the owed balance? How much do I currently owe on this credit card? My interest rates, what are the rates in which I have to pay in order to borrow this money? What method are you using to calculate my balance? Is there a cash advance attached to my cost or to this credit card? Grace period, how much time do I have to pay before you start to charge interest? Typically 30 days is a grace period on most credit cards. Annual fee, is there a fee attached to this credit card that I have to pay each and every year just to carry it, even if I never use it? Are there additional penalties or fees attached to this credit card? And what are they? Again, the fine print on the back of the application. Make sure you read that carefully. Annual percentage rate, the APR. Again, we go back to this as being kind of the true simple interest rate paid over the life or annually on the loan. One thing I'm going to warn against, if you are applying for a credit card and you get solicitations in the mail, be careful of what they refer to as teaser rates. Teaser rates are rates that are like introductory rates. It'll be in big bold print on the envelope or the application, used to attract new customers. It looks great. It's a low interest rate. But unfortunately, in the fine printer at the bottom, it says, this only lasts for a short period of time, first 3 months, first 6 months, first year. We go from a 0% or 2.9% upwards of 17 to 25% on the credit card. They tease you to get you to apply for the credit card. And now that you own it, after 6 months, 8 months, a year, whatever it is, during the rate or during that time, that window, they then increase your rates and charge you more money on your credit card. I will tell you that one extremely expensive way to use or borrow money on a credit card is your cash advance. And there's not a lot of opportunity. There's not a lot of examples in which you would probably need to use cash in American society today. However, if you choose to take cash off your credit card, a cash advance, it is an extremely expensive way to borrow. What happens is usually there is a cash advance fee attached to you taking cash off your credit card, anywhere from 2 to 4% of the amount borrowed or advanced. And some credit cards are going to require that you pay off your cash advance fees and your cash advance balance before you pay off any other purchases on that credit card. So they're going to charge you a higher interest rate, they're going to charge you a higher fee or an additional fee, and they're going to make you pay off that credit card cash advance before you can start to pay off any other balances on your credit card. Cash advances, extremely expensive way to borrow. Going back to some of the additional fees that may be attached to a credit card. a cash advance, like I said, at a late fee. If you're even 1 day late in making your payment, they can charge you a fee. Over the limit fee, let's say you have $1,000 credit limit, you spend $1,000 in one, or 1,000, 1,200, 12, whatever it is. If you are over the limit of your $1,000, they can charge you a fee. There are additional penalty rates. So again, be careful, alert, look for things like important notices of change of terms. Make sure you again are reading the fine print on the back of the application. Understand what you're getting yourself into when applying for a credit card. The 3 C's of credit, the 3 things you're going to look for when you apply for a loan or a credit card. Number 1, character. Who are you? What kind of person are you? What is your character? 2, do you have anything of value? How much money do you make? What is your current income? Your capacity to pay back this loan? And again, 3, collateral. Do you have something of value, your home, a car, boat, that we could collect and use if for some reason you are unable to make your payments or repay us on the loan? Character, capacity to pay, and collateral are the 3 C's of credit. If and when you apply for credit or a loan, your credit evaluation will be sent to a credit bureau. The credit bureau will collect and report information from creditors, public records, any other things that might be related to the consumer, to ultimately determine your credit worthiness, which is a score. The credit score determines whether or not you qualify for this credit, this loan, and at what rate. Here is an example. Scores typically range anywhere from 300 to 850. Now, if you have not established a lot of credit or you have poor credit rating, you are probably going to fall in the 300 to 1619. That is a poor credit score, which means you probably will not be approved for most loans. A score of 800 is considered excellent. And again, if you apply for a loan, a credit card, whatever it is, and you have a score of 800 plus, you are going to be considered excellent and more than likely be approved for that loan. Most credit scores of average Americans fall anywhere from 600 to 750. Additional factors that can determine your credit worthiness: your annual income. How much money do you make each and every year, annually? The length of time at current residency. How long have you lived there? Your current job, your employment. How long have you been employed? What type of residency? Do you own your home? Are you renting? Your age, employment history, additional bank accounts or credit cards. Do you have other credit cards or other loans out there? How many accounts do you have? Your overall credit history, going back to the score and what your score or rating is at. Chapter 4 has some vocab terms that I need you to be familiar with. And again, I go back to some of your 3 C's, your character, capacity to pay, and collateral. Collateral is something of value that a borrower can use basically to promise that they will repay their loan. Credit rating is the score or the rating of risk involved in lending you money. So if I'm the bank, the lending institution, and I were going to lend you money, what is my risk involved in lending you this money? What is your rating? Credit check is simply an investigation, usually through the credit bureau, in which I'm going to check things like your past history, your character, your current debts, what is your income, and this usually is filed through the credit bureau when doing a credit check. Next, we're going to talk about loans. If you were to go to a lending institution, a bank, financial institution, whatever it is, your credit union, and you are going to apply for a loan, there are typically 2 types of loans. There are secured and unsecured. A secured loan is a loan that is guaranteed or backed by collateral. And again, collateral is something of value. In this case, I show a boat, something in value that I can use to help secure the loan to make sure that if you can't make your payments, I will simply collect this collateral from you. Now, the good thing is if you have something of value, a collateral, this will typically lower your interest rates on your secured loans. An unsecured loan does not require collateral. You do not have to have anything of value that I can collect, and it is typically offered to borrowers with a high credit rating or credit score, excellent credit history. It's just a promise to pay back. I promise you that I will pay your money back to you. Now, these will normally have or typically have higher interest rates, anywhere from 12 to 21% each and every year or annually. So unsecured loans, things that are not backed by collateral, typically have a higher interest rate. Next, we will talk about two types of loans as far as the rates involved. You have a fixed rate loan and a variable rate loan. A fixed rate loan, let's say you were to apply for a mortgage, a 30-year mortgage on your home. A fixed rate would mean that for those 30 years when you're making your payments, the rates will remain the same. It is fixed. It is locked in. So if you're able to lock in at a low interest rate on a fixed rate loan, it will remain the same. Your payments will be the same throughout the duration of the loan, the next 30 years. They have the same interest rate for the duration. Normally, they are a little higher initially, just because the lending institution, the bank, could potentially lose money if rates were to increase. I will tell you that most consumer loans are fixed rate loans. Variable rate loans have an interest rate that is tied usually to our index. So if you're looking at the stock market, the economy, with things in value, this is going to be related to those indexes. They can adjust different intervals. So a variable rate, again, the rates could vary, and it depends on what's happening in the index on the economy. It could be monthly. They could go up. They could also go down. It could be semi-annually, annually. You never know. So each and every month on a variable rate loan, your payments could change. They could increase. They could decrease. Variable rate loans normally have a lower initial rate because the lender won't lose money if the rates were to increase. So if I'm a credit union, I lend you money on a fixed or variable rate loan. If I lend it on a variable rate loan, I could potentially lose money if the rates were to decrease, which would mean you would pay less each and every month because the rates have gone down. So I could potentially lose money. So there is that risk involved in lending you money on an initial variable rate loan. I want to thank you for watching, and I hope all of you